Hey, welcome. Today we are diving into a question that sounds really simple, but trust me, it's not. What actually makes an asset an asset? We're about to go on a journey through three completely different competing ideas about what value really is.
So let's just put it right out there. What is it? Is it something you can hold in your hand, something tangible? Is it something that pays you every single month, like a little cash machine? Or is it something way more abstract, maybe just a promise on a piece of paper? Well, the answer really depends on who you ask.
All right, so here's the game plan. We're going to kick things off with the oldest idea of value there is, gold. Then we're going to switch gears completely and think like a cash flow investor. From there, we'll challenge the very idea of your house being an asset, explore the incredible power of a simple contract, and then, at the very end, we'll bring it all home and ask the big question, what is the real asset?
Okay, first up, we're talking about a philosophy that has been around for thousands of years. It's this core belief that a true asset is something you can touch, something real, something you can physically hold that keeps its value no matter what's happening in the world.
And really, the poster child for this whole idea is, you guessed it, gold. Think about it. Empires have risen and fallen, currencies have turned to dust, but for millennia, gold has been seen as this bedrock of wealth. Its value isn't based on what it does, it's based simply on what it is.
And this really gets to the heart of its appeal. Whenever investors get jumpy, worried about a recession or chaos in the markets, they run to gold. The whole idea is that stocks can crash and governments can print money like there's no tomorrow. But gold will still be there, holding its value.
But, and this is a huge but, here's the powerful counterargument from one of the most famous investment books ever. While your gold is sitting there, being all safe and shiny, it's not actually doing anything for you. It's not earning you any money. In fact, it's actually costing you money just to keep it somewhere safe.
And this number just drives that point home. 0%. A bar of gold today is just going to be a bar of gold in 10 years. It doesn't grow, it doesn't have baby bars of gold, and it definitely doesn't mail you a check. Now, for a whole other school of investors, this isn't just a minor detail, it's a fatal flaw. And that brings us to a completely different way of seeing the world.
So let's pivot to our second philosophy. This one argues that an asset isn't some passive lump of metal at all. No, an asset is an active system. It's a machine, and it is designed for one single purpose: to make you money.
For this mindset, the most important thing in the world is a metric called net operating income, or NOI. If you're a real estate investor from this school, you don't care what the house down the street sold for. You care about how much cash this property spits out after you've paid all the bills. The higher the NOI, the more valuable the asset. It's as simple as that.
And this philosophy has its own playbook, a really popular one called the Burr method. Let's just walk through it real quick. First, you buy a property that's a bit of a fixer-upper. Then, you rehab it, you fix it up, forcing the value to go up. Next, you rent it out to get that all-important cash flow going. Once you can prove it's making money, you go to the bank and refinance, which lets you pull all your original cash back out. And here's the magic step: you repeat the process. See, the goal isn't just to own one cash-flowing property, it's to use the money from that one to build a whole fleet of them.
Now, if you follow this cash flow first logic, it leads you to one of the most controversial ideas in personal finance, one that basically flips the American dream completely on its head.
And there it is, the most famous line from Rich Dad, Poor Dad. I mean, for generations, we've all been told that our home is our biggest asset. But if you're looking at things purely from a cash flow perspective, Kiyosaki says that's dead wrong. So how can that possibly be?
While the difference is actually brutally simple. An asset puts money in your pocket. A liability takes money out of your pocket. Think about your home. You've got mortgage payments, property taxes, insurance, repairs. It's all money flowing out every single month. But a rental property, if you do it right, the tenant's rent covers all of that and leaves you with profit. That's money flowing in. In this world, the only thing that matters is the direction the money is flowing.
So, we've looked at assets as tangible stuff, and we've looked at them as income systems. Now let's get into our third philosophy, which is, well, it's a lot more abstract. This idea says that the most powerful asset isn't owning something at all, it's controlling it. Let me tell you a quick story to explain. Okay, so here's Farmer Brown. He's got a nice 100-acre farm. Right now it's worth about $10 an acre. Nothing too crazy, just a regular old farm. Now you come along, but you don't buy the farm itself. Instead, you buy a piece of paper from Farmer Brown, a contract. And this contract gives you the choice, this is key, it's not an obligation, it's a right, to buy his farm for that $10 an acre price anytime in the next 90 days. You just pay him a little bit of money for that right.
Then, a week later, bam, lightning strikes.
Geologists discover a huge oil reserve right under the farm. And overnight, the value of that land just explodes. What was $10 land is now worth $10,000 an acre.
So, here it is, the multi-million-dollar question. A big oil company rolls up, ready to drill. Who do they need to talk to? I mean, Farmer Brown still technically owns the land, but you control its destiny. You have the piece of paper that gives you the right to buy it for next to nothing. The oil company? They have to negotiate with you.
That little piece of paper you bought? That's what's called a derivative. More specifically, an options contract. Its value is derived from the value of something else, in this case, the farm. So when the farm's value went through the roof, the value of your piece of paper, your right to control the farm, went right through the roof with it. You controlled a multi-million-dollar asset without ever actually owning it.
All right, so we've been on quite a journey, right? We've explored these three totally different worlds: the world of tangible stuff, the world of income-producing machines, and the abstract world of just controlling things with a contract. Let's try to put it all together.
So here's the bottom line. Each philosophy defines an asset differently because each one has a totally different goal. For the store of value folks, the asset is a real object, like gold, and the goal is just to preserve your wealth. For the cash flow crew, the asset is a system, like a rental property, and the goal is to generate income. And for the control camp, the asset is just a right on paper, like an option, where the goal is to use leverage to get huge gains.
And all of that leaves us with one final question that's really for you to think about. When you put your own money to work, what are you actually trying to buy? Are you buying an object, hoping it doesn't lose value? Are you buying a little business, hoping it pays you every month? Or are you buying a right, a choice, hoping to turn a little into a lot? Your answer to that question will define your entire strategy.